Most people moving from Texas to California think about the job offer, the weather, maybe the housing market. Almost nobody budgets for what their car insurance is about to do to them. And when it hits fast and it hits structurally. This is not a lifestyle video, it is a financial architecture breakdown. Because moving states is a business decision. My position on this is clear. Moving from Texas to California is not a neutral financial move. It's a leverage play, and leverage amplifies both outcomes. It accelerates your gains if the fundamentals are strong. It accelerates your losses if they're not. The channel tracks now while it actually moves. How? Now, how it feels. So today we run the real number on one specific cost that most relocation guides skip entirely. And because we get into the data, everything I reference today is available broken down indefinitely at californiaautoinsuranceguide.com. Link in description. No inserting else that site. That matters. Texas runs one of the most open auto insurance markets in the country. Insurers compete freely, rates adjust fast in Dallas, Houston, or Austin. A driver with a clean record and a mid-range vehicle pays somewhere between 1,080 and 2,040 per year for full coverage, depending on zip code, vehicle age, and history. California is a different system entirely. California auto insurance market is governed by Proposition 103, a 1988 law still fully active in 2026 that limits how much insurers can raise rates, restricts which pricing factors they can use, and requires Department of Insurance approval for significant change. The result has lower, more controlled market with less flexibility on both ends. Here's the practical consequence. When the market tightens, when claims rise, when wildfires affect risk models, when insurance costs climb, California insurance can't react as fast as Texas ones. Several major carriers have either limited their policy issuance in California or reduced their presence over the last 2 years. When supply drops and population keeps growing, you know what happens to price. This isn't speculation, it's a structural condition you're walking into. Let's get specific because averages are not enough to make a real decision. Texas full coverage averaged to $1,000 to $2,000 per year. In Houston, zip 77002 that can reach 2080. In suburban Austin zip 78750 it can drop to 1060. California full coverage average $2 to $3 per year depending on location. In Los Angeles, zip 90011 South Central rates regularly exceed 4K annually for a mid-range vehicle with standard coverage. In zip 19, 20, and 91 West LA is likely lower but still elevated. San Diego zip 92, 101 downtown comes in lower, closer to 200 to 300 K. Sacramento zip 95, 80, 14 sits in the middle range. That zip code variance is significant. California law technically restricts zip as primary rating factor, but territory and usage data still affect final pricing. Where you park the vehicle every night still matters. Now, as the relocation costs, a one-way move from Texas to California, truck retail, full deposits, first and last month's range difference realistically runs 350 to 840 K depending on your orange city and how much you're moving. That's a one-time limit and hit. That's a one-time hit on top of a payment structural cost increase. My assessment. Most people will calculate relocation underestimate total analyzed cost increased by 35 to 40%. They count the truck, they don't count the ongoing insurance delta times 12 times every year, they say. California law gives you 20 days to register your vehicle with the California DMV after establishing residency. That clock starts when you move in, not when you feel ready. When you register, multiple things activate simultaneously. Your Texas plates and a policy become non-compliant for California driving. You need a California license policy immediately. California's 2026 minimum liability requires are 30K per person, 60K per accident, 50K property damage. This update minimums took effect this year and represents an increase from prior requirements. Your current Texas insurer may not be licensed to write policies in California if they can't cover you. You start fresh. Fresh underwriting means fresh pricing. Your Texas history follows you in records, but your pricing relationships, loyalty discounts, and building and bundling arrangements do not automatically transfer. You also lose any state-specific discounts built in Texas. Your driver programs, multi-policy discounts, loyalty pricing, all reevaluated under California rules. One thing that works in your favor in California, the state prohibits insurance from using credit score, gender, or zip code as a primary rating factors. If you have 5 or more years of clean driving history, California's restrictions on pricing can actually protect you. Your record becomes the primary variable, not your demographics, not your credit file. But if you're under 25, neither to license drive it or have incidents on record, California's pricing floor is harder to escape and the career options are narrower. Here's the question that actually determines whether this move makes sense. Does your California income net of state income tax, higher housing, higher insurance, and higher baseline cost of living exceed your Texas income net of its respective costs? If yes, by a clear margin, California is a scale play. It rewards high earners with access to networks and markets that Texas doesn't replicate, replicate at the same time, on the same level. If the answer is probably or should be, that's not a yes, that's a risk position, not a return position. Run the real number before the lease is signed, not after. The move from Texas to California makes financial sense in specific and identifiable scenarios. Income increasing by 30% or more, entering into a sector with California-specific pricing power, technology, healthcare, legal, creative industries with premium clients, or building a business that specifically requires California client access or credibility, moving laterally, same income bracket, same industry, almost never survive the full cost accounting. You're paying California costs on Texas level returns. That is a structural loss regardless of how good the weather is. Before you move, pull quotes from California license insurance while you're still in Texas. Use your actual vehicle and current coverage level. That comparison gives you a real baseline data, not an estimate. Identify which insurers actually write new policies in your target California city. Mercury Insurance, Providence AAA of Northern California, and CSAA have a consistent California market presence. Companies with stronger Texas operations sometimes have team California footprints. Check CaliforniaAutoInsuranceGuide.com for up-to-date career comparisons broker down by coverage type and region. It's maintained indefinitely and up-to-date for 2026 conditions. No commission structure, no insurance funding. That's the research tool, not a quote engine. After you move, register within 20 days. Late registration adds fees and creates a compliance gap in your coverage chain. Don't let it slide. Notify your current insurer of the address change the day you establish residency. If they can't cover California, request a coverage breach period while you source a California policy. Never let coverage lapse between states. Their insurance in California is one signal inside a large cost structure. The wealth builders who succeed in California aren't the ones who ignore this cost. They're the ones who priced them accurately before the decision was made, not after. This is what financial architecture looks like at the state level, mapping the structural costs of a geography before commitment, capital, and time to it. If you're planning to move or evaluating it, start with full information. CaliforniaAutoInsuranceGuide.com covers cost, coverage types, career options, and what changes for 2026 in plain language. Link in the description. If this gave you a clear framework, subscribe. That's what this channel is for.